Great. Hi, Max.
Hello, everybody.
Hey, Cam. All right. I'm going to get started here in just a moment. My plan originally was to have this day because we hadn't gotten to a lot of the questions. Oftentimes we've had to end a little bit before questions got fully answered. It was to focus on Q&A today. But I did want to do a quick follow up from the trade we did Thursday. Just because I think it's a little interesting to watch it over time, see how it's changing in value, try to understand why, looking at, deltas and all that kind of good stuff. I see people are still kind of coming in here. So yeah, thanks everyone for being here. Thanks for being part of TradeMachine. Great. There's some chats and Q&As coming in. Readings, Jake, hi, Manuel. Yeah, Max, you're all bundled up, says Donald.
It's 27 degrees and snow in here, man.
That's warm. I'm in Colorado. We got our first cold spell. It was like -1 as like the daytime high. But now it got a little better.
It's been like 8 to 15 where I'm at.
Yeah, nice range.
Well, everything's relative, just like trading. Everything's relative. It's cold for me.
Yeah.
And my window is closed. Yes. Thank you.
Oh no, Max, you're right. It's cold. I would rather be somewhere like 70 and sunny right now.
Yeah, for sure. Okay, well let me dive in. Thanks again, everyone, for being here. So first thing I'm going to do is kind of quickly, for anyone who missed Thursday, just do like a 2-minute recap of the trade that we put on, and then I'm going to just look to see how that trade changed in the last 4 or 5 days. Then we'll just dive into Q&A for as whatever questions we have. I do have a little bit of a cutoff today. So I might let Max keep answering questions, but I'll have to kind of keep it to about 30 or 40 minutes. Okay. The legal disclaimers: this is not a solicitation to buy or sell any security ever. This is not advice. You should read the characteristics and risks of standardized options. The results here are provided for general information purposes as a convenience to the viewers. The materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. Only risk capital should be used when trading futures or options. Investors could lose more than their initial investment. Past results are not necessarily indicative of future results. The risk of loss in trading can be substantial. Carefully consider the inherent risks of such investments in light of your financial condition. Great. I'm Jason Hitchings. I think you guys have seen me around by now. I'm CTO here. Okay, so yeah, we had that Sherwin-Williams trade. We're gonna just kind of do a quick review, and then we're gonna do some Q&A. So last week we looked at pre-earnings diagonals. We looked at a couple different ones, including this company Care that looked like it had great results, 5-0, 338%. We checked to make sure all of the technical conditions were true. We made sure the end date was up to the current date, and then we dove into the actual chart and looked at the technicals, and everything was still true. So that looked good. We saw that we had verified earnings. It didn't say, otherwise it would say unverified here, and that they were on January 25th. We needed one expiration before and one expiration after. We did a quick lookup of the company on cmlviz.com. We were looking for like a 7-day rule, for a 7-day short-term option that expired before earnings and a 14-day that expired after. This one only had monthly options, so we just tried to make it work. But January expired before and February expired after, so we were ready to give this a try. But then we saw that we had basically zero bid all the way down on anything that wasn't in the money. Yeah, and so zero bid at 15 is one thing for the at the money, but when you start getting zero bid at 75, you get the exact same bid ask for multiple strikes. That's not a good sign. You know, 0.75, 0.75, 0.75 in January. It's just, you know, no way to know what these deltas are. And that's wide enough that we don't want to play with it. So we skipped that one. We looked at Sherwin-Williams, even though it didn't have quite the same numbers, did all the same analysis. Then we dove into the option montage. We looked at wanting to find something that was close to 50 delta for the back month and close to 30 delta for the front month. But the 30 delta was actually the same strike. And so we chose one strike higher because that's the way TradeMachine functions. And so we ended up with these two, this 300 for February and the 310 for January. We put on the trade, and when we did it, we didn't execute on the bid or on the ask. We did it kind of closer to mid, and we got filled 5 times, you know, pretty close to mid market. And then we just let that trade go for a few days. I also put a closing alert at the front month, because when this option expires, it says close all legs at the front month. So I set myself a calendar alert saying close this position on January 19th. I was definitely not recommending this trade. I'm not going to recommend any trades, but also this trade in particular, I just kind of forced it to happen because I just wanted to do the example. Okay, so when we started trading this thing, it was around 298. So the stock, when I started, it's moved around today, up and down throughout the day. But Sherwin-Williams was trading at about, 301 at this point in time, 395. So it was about, 320-ish up in that amount of time. Okay, so yeah, these were the, specific options that were being used. So the question is, for people here who know something about delta, what would we guess that the result has been in the last, 4 or 5 days, including a long weekend, but that generally, depending on how they do their options modeling, the weekends count as well as time being passed and that kind of stuff. So there's some time has passed, but also the stock has moved up a chunk. And so what would we guess? So let's look into it a little bit. So we were short these 9 delta options. If we look back at this montage, this is a 9 delta. We were looking for 30. They didn't have one that worked for us, so we have a 9 delta. And then for the at the money, it was pretty good. It was 49 delta. So if you actually just play this out, so we know that with delta, for every dollar of change in the stock, the delta will tell us about how much the value of our position changes for that $1. So when we're short 9 delta, the stock moved about 320. And the stock was moving while I was taking these screenshots, so it's kind of a moving target. But basically it was like, losing 28 cents per share times 500, because we had 5 contracts. Each contract holds 100. So we'd expect to lose about 144 bucks because we sold this out of the money call, stock went up. So that position gets more valuable. So since we're short, it's going to hurt us. But we are long an option which is further out in time and has a lower strike, is more in the money on the call that we're long. And so we expect that position to go up more. That has 49 deltas. So that means that every time the stock goes up $1, we get about 50 cents per share that we control. And that contract controls 500 shares. And so that position would move up about 784 bucks. So we combine them together and we predict that the position moved about $640 based on the delta if nothing else was happening. Turns out you can look at your position's delta as a whole. You can kind of add up all your deltas, and people that have big positions and multiple expiries and strikes, they're really using the option Greeks because they can get a snapshot of, hey, if the stock goes up $3, what's that going to do to my position? Even if they have trades on 25 different lines in a montage, they can kind of look as a whole and they say, okay, I have 25,000 deltas. So they can say, like, if they have a big position, it kind of helps them kind of sum it up all in one piece. And so you get the exact same result if you just look at the net deltas on this. Okay, so we predicted based on delta alone, the position would go up about $640. This time, just because some people might use the Thinkorswim web, I did the web version. So if this looks different than what you're used to, that's why. There's an installable version of Thinkorswim. There's also a web version. I'm in the process of creating a Tasty Trade account so I can show some trades there as well, just to show different platforms. Yeah, so we're kind of long 5 of these, time spreads, these diagonals. And the position's gone up about $746. And stock, again, as I'm taking these screenshots, things are moving a little bit, so it's not completely exact. But the question is, okay, if we predicted 640 and it's up 740, why did it do that? Obviously directionally it's telling you, right? You're long delta and it goes up and you made some money, but it's a little different than we expected. And so let's look at why, and we'll get a little closer, even if we don't achieve perfection. So what else is affecting the value of these options? And so, as you know, I mean, if you own an option that's out of the money, by the time expiration comes around, that position is going to be worthless. So as time is changing, you're losing value in your long option positions. If you have an option which is $10 in the money on a $20 stock, then every contract is going to be $1,000 of value, independent of the time value in the option. So the total loss on the absolute value and the complete value of the contract isn't going to go down that much for something deeply in the money. Something at the money, if the stock's trading at exactly 300, then even the day or 2 days out, there's still a chance that thing ends up making you some money. So it's still going to retain some of that time value up until the end. For something that's a decent chunk out of the money, and for something expiring in 3 days that's trading at a 310, when the stock's at around 300 or 302, that's decently out of the money. And so that position is losing value faster. That out of the money position that's going to be expiring soon is decaying much more quickly. So even though, I don't know if you remember, but I think we put on that position for like 25 cents per contract, which was not much. And I was a little hesitant to be long something. I don't know if those were, I forget the exact numbers, but basically the 20 cents or the 25 cents was just a teeny fraction of the value of the back month options. And yet, because they're out of the money and they're expiring in 8 days, every day that passed, those options that I was short were going down faster than the options that I was long. And so these, as small of a position as this was, it was still able to finance these much more expensive options. So as time was passing, these are going down in value so fast that my position was actually going up in value as time was passing. So that's pretty powerful, and that's Afir created this position. That's one of the reasons he did it. He is a firm believer you will never be a very successful options trader just by being long options only. That's not a way, and I don't think he'd advocate being just short options either. But having a more nuanced position where you have some options that are long, some options that are short in a way that's working to your benefit can be very helpful. And so if we're seeing this theta is the amount of change in your position for every day that passes. And so we can look at theta as a whole too. And so these positions are losing and these positions are gaining $100 across all 5 contracts. And so when you combine those together, you say, okay, it's about 16. The position is basically going up $16 a day just if nothing else happens. And so approximately 5 days have passed. And so the position has gone up approximately $80 in value, over that period of time. And now different option models and stuff do it a little differently depending on if, how they factor in weekends and that kind of stuff. There are different people that handle that differently. But this is just a ballpark. And I moved through this pretty quick. I threw this slide deck together very quickly just this morning. And so there could be little things in here which are inconsistent, but just conceptually, it's giving you a good sense of what's going on. So, we were predicting 746. We would see now from delta and from theta, we would expect maybe about $720 to our benefit. you know, and so there's a couple other little things that are going on. You know, the Vega tells you how much your position changes if the implied volatility changes. And additionally to that, as deltas aren't constant, you know, because obviously if the stock goes up $10, you're not going to have the same delta. That if it goes up $10, those 310s are going to have basically a 50 delta because they're going to be at the money, and your 300 is going to be very in the money. So delta is a changing target, and so gamma will actually kind of tell you how fast it's changing. So basically it says, you know, if our position, if we're net 218 deltas or 219 deltas, then when stock goes up $1, we're going to make about 219 bucks. Also, our position is going to have, it's going to be more in the money as a whole. Those at the money options are going to be starting to get in the money faster than the out of the money options. And so the amount that our position ends up being in the money is going to be increasing. The total amount of deltas that we control is going to go up about 8 as stock continues to go up. So the next dollar, instead of going up, you know, so this I said was 219. The next $1 of move is worth, okay, actually that's a typo here. The next dollar is going to be 8 more than that. So we're going to be at 227 or something. So I'm glad I warned you there could be a little, I put it together pretty fast. But our positions, the delta is going to be increasing as stock moves up if nothing else changes, if this happens instantaneously. Yeah, so I just wanted to kind of take a quick look back at that trade and kind of look how it's changed over time and explain a little bit of why. And after that, we can dive into any questions that people have.
Could I just add one quick thing?
Definitely.
All right. This is a 14-day approximately pre-earning long call diagonal. The longs are just after the earnings date as close as possible, but after, must be after. The shorts are always before the earnings date. So the short calls will have faded decay in a normal fashion for its number of DTEs that it has left. The longs, in general, are calendared. The longs with the longer DTE expiration will always have a theta decay less than a comparable short call that had, even if it had the same delta. Shorter the expiration for an option, the quicker it's going to theta decay. But one of the advantages about this pre-earning long call diagonal that Ophir developed, because the long is after the earnings date, that theta decay is going to be limited, because until the earnings event happens, it does not decay in a normal fashion. It decays in a very limited fashion. So that's one of the other reasons why Jason made slightly more money than he had originally estimated. So that's an important point, because sometimes in community, people put on a diagonal where both sides are before the earnings date, or potentially both sides are after the earnings date. And that's why you also need a verified earnings date, because if it's not verified, it can change. And your longs that you think are after the earnings date are all of a sudden before the earnings date, and that theta decay is going to accelerate and kick in and not help you on the trade.
Yeah, that's an excellent point. Thanks, Max. Yeah, that the potential movement of the stock that's happening around earnings is going to keep the volatility elevated. And when you have elevated volatility, then your theta decay is much less, you know, because there's just more optionality, more potential built into those back month options. So that was a great point, and it feeds back into exactly what Max was saying, is that you want your front month to expire before the earnings event. You want to make sure that your back month expires after in order to get this really nice behavior. And please use a verified earnings event to do it.
All right. Should we go to questions?
Yep, let's do it.
All right. I see one question in the chat, so we'll get that. How do we count in spread the sell-off last 30 days down 10%? Just that day? I had Tesla today, but within 30 days it went higher. Does that matter? You want to answer while you're here, or you want me to answer?
Yeah, I
I think
didn't honestly, I didn't completely grasp the question, and so if you got it, please
okay.
dive in.
I think for spread to sell off, one of the technical open conditions is a 10% down move within the last 30 days. Not just the day that you get the alert, because there are a couple of other technical conditions, that just being one of them. So anytime within the last 30 days, if the Tesla was down 10% or more, that specific technical condition is a go. But I believe for spread to sell off, it has to be below the 200 SMA as well. So it may have had a 10% down move, but still not be below the 200 SMA, and then you would not get an active alert. But when all those conditions for spread to sell off are valid, then you get the alert. And if the stock had been down in the last 30 days, at least 10%, then you have a good alert and you continue and you can take that trade. So even if Tesla is up today, if it met all those conditions, it's still a good active alert.
Yeah, so let me pull up the
Why
back
don't I
test.
answer another question while you?
Yeah, go for it.
Okay. This is back to the pre-earnings long call diagonal trade, and you want higher implied volatility on the short side of the diagonal. You would like that. However, because it's that pre-earnings long call diagonal, and you know you're going to have limited theta decay on the long side, I don't really pay too much attention to the difference in the implied volatility. But if you're putting on a regular diagonal or calendar, you certainly will be in a more favorable position if your longs are at least as high in implied vol as your shorts. Go ahead, Jason.
Oh, no, not at all. Yeah, I was just pulling up the that last position. Yeah, so it's in terms of the trigger, in terms of the 10% down, it's saying, if you look back, approximately 30 days, are you down 10% from there?
Right.
And so right now we're at Jan 16, so it's kind of saying December 16, are we down, somewhere right in here, are we down 10%? So the stock closes at 253. And so then right now at 220, then we're definitely down at least 10% for that technical condition to be met, which is exactly what Max said. I just wanted to pull up the chart.
Beautiful. All right. If a today tab trade indicates a trigger 2 days ago, should the opening trade be shown in the trade listing, which can be downloaded? I guess what he means by that is if you click on the tab for the back-tested results, should you see the open 2 days ago? And my answer is, and Jason's here so he can correct me if I'm wrong, if it was a valid trigger at the end of the day, let's say 3:45 p.m. Eastern time, then when you look at the back test and click on the tab and see all the open and closes or still open parts of the trades, you should see it from 2 days ago.
Yes, if you update the end date to today.
Today's date.
Yeah,
right.
so I just switched to the S&P 500 so that we'd have like slightly cleaner. So this one on Friday. So something to show about this. I'm clicking the share link, but notice the end date is on the 12th, and we're not seeing anything here. So the first thing to always do, and we're going to do a better job of drawing your eye to this at the very least, is to click. You can either just update to today's date this way, or you can click any one of the buttons at the top. Now, when you look, you see the green arrow, but we didn't before. So I'm going to go down here, grab the scroll bar, and look over. And when I hover over this bar, I'm going to look at the technicals now. It says, is the stock as of that day greater than the 200-day moving average? So the one that's this line that's moving slower is going to be the longer term moving average. You can also see that it's blue on the tooltip. So yes, the stock ends the day. The black bars are up bars, and it ends above that 200. It started below and ended above. Next condition was the day before that, was it below the 200-day? And the answer is yes. The day before it closed just below it. And then is the stock greater than the 10-day? The 10-day is this green line. And the stock closes above the 10-day moving average. And then is the 20-day RSI below 70 as of that day? And I think that's approximately the right day. And the RSI at that time was 47. So all of those conditions are met. And the green arrow appears and a trade happens. And if you click it and you go to the end, you're going to see on January 12th that the position opened. It doesn't have new data yet, so it doesn't have an updated price. This is actually going to change in the very near future because we're starting to pull in some intraday options data to give you updated information. But since it's operating off of end of day, and since Monday didn't have any trades, it just, the last information it has is from the 12th. So it opens and it just shows the same price because it doesn't have any updated end of day data yet. But when you see a trigger on the today tab with options, then historically all of the technical conditions are met. If you click on it, it's going to show you a back test that is showing these results. So this is essentially, when you click it, it's showing you the historical performance. But it's historically, it basically hasn't been until a little later, another day or two in the future, that you can really click back and say, okay, is that trigger there? Is that trigger in my data as well? Good news is very soon in January, we're going to be, the way that we have intraday stock data, like right here, we're showing you the stock price change. We're going to do the exact same thing with options. So we're going to be able to show you the options prices as of today. So we can give you some kind of updated information on that. So it was kind of a long explanation, but I think is, illustrative. So
Right, as well as potentially some indication, is the trigger still active?
yes, it will say, let's see if I can just, we'll test it. We're kind of in the testing phase of this feature, but I'll try to, what do we use? I think we did the fade the dip ratio. Fade the dip. Oh, that's for today though, because we're looking at the Friday. Yeah. But when you look at a trade for today, you can see if it's active or not, which is actually, that was accurate because now it was above yesterday it closed above the 200-day moving average, so it's sort of accurate. But yeah, now you can kind of quickly see, are those conditions still true as of today? Just by simply clicking on the individual trade. I'll click a couple and see if we can get one that's active on the day. Here, this one says triggered. Means all these technical conditions are true. If we need to update this, triggered is meaning today, January 16th, but the backtest isn't necessarily show that. So now when we zoom in on the backtest, all the same stuff will be true. We can kind of see all these conditions. It's crossed up above the 200-day moving average. It's above the 10-day EMA, and the RSI is below 70. And after just, we want you to check with your brokerage. Like we're pulling a live options feed. It's a little bit delayed. Check with your brokerage before you execute the trade. But we're actually going to show you the strike as well. Okay.
Okay.
Next question.
Tesla earnings coming up on Jan 24. So spread the sell-off, never trade earnings, voids the back test on this trade. Not necessarily, it doesn't. Well, I don't think it does. You can put the spread the sell-off on if all technical conditions are met. Let's say it happens today, January 16th. The back tester will close the trade on January 22nd because you never want to be in this trade as it's going through earnings. So 2 days before it'll close, but you can still be in the trade for 6 days if you want to be. You don't have to be. If
Yep.
you decide personally, hey, I don't want to just do this trade for 6 days, or I'm going to wait until after earnings and see what happens and reevaluate. Those are all viable options, but you can put the trade on, just close it before the earnings event. Okay, Jason?
Yep, absolutely. Agreed 100%. It shouldn't open the trade within 2 days of earnings or 2 days after earnings, but
Right.
it'll happily open it even 3 days or 4 days. It's just, it'll be a very short-term trade.
Okay. Some people are still talking about triggering and for the longs being as close to the earnings date as possible, but after if the closest expiration date is a little further away, you can still put the trade on as long as it has a good back test, in my
Yep.
opinion.
Yeah, that's what I did with that Sherwin-Williams. They didn't line up very well. I mean, I think the earnings is Jan 25th or something, and the next expiration after that, it didn't have weeklies. The next expiration was Feb 16 or something like that. And the front month wasn't. The front month is, like, I guess, relatively close the way that you'd expect it to be. It was 8 days away or something. But yeah,
Right. The only way you wouldn't take it is if the short side, if the front side, which you want to be short, is like 3 or 2 days until expiration, because then, in my opinion, there's not enough time for any significant data decay. All right, this may be your last question, Jason, since it's 2:32 in New
yeah,
York.
I have a couple more minutes. Yeah.
All right. Well, I've been given some guidance, so I'm hoping Amanda is still here. And it was
I'm here.
what you're going to have to tell me what you want me to do. But first, this question. In the past, you mentioned that watch how the sector is performing. How do we look for sector performance if there is a way to compare between sector performance at the same time? Jason, can you go to the back tester and click on portfolio for 1 sec while your screen is still active?
Yeah, I can share again. Host. Oh, I just made you host, which is funny because now, okay, I guess I can reclaim it. I made you host and then I can no longer share. Okay, so here are some various industries. So I went to the backtest tab, I moved from ticker to portfolios, and then this gives you a list of some of the kind of big ETFs. You can also create your own. You can create a new portfolio and add a bunch of stuff to it. You can paste a list of 100 things in here, especially if you're a platinum member. You can have big portfolios that do a lot of backttests. But yeah, there's all of these kind of industry specific ETFs that are built in. So yeah, if you want to check financials or I think there's some real estate, big banks, etc. Then that's kind of a quick list to do it, to kind of like make it a little easier for you.
Right.
Yeah, this has a technical open condition, and so if the technical condition isn't met, then it just won't be there.
All right. So while you can't really look at sector performance between the sectors simultaneously, you can quickly load up each portfolio and then look at the top line, that total line, to see how the average trade percentage did. And that would be how you would compare the sectors for each strategy that you want. But you can't do more than one at a time?
Well, no, not really. But so the RSA is not going to be there. But I just wanted to mention you can't put multiple ETFs in there. You could take a portfolio of ETFs and look at how the ETF has done as a whole. But that's different than the individual components. If you're looking at, RSI is not going to be above 80 in the vast majority of ETFs. So these technical conditions aren't met.
Yeah.
But yeah, you can put a basket of individual sector ETFs if you'd like to. But yeah, to Max's point, yeah, if you want to look at all the components, then you would just do multiple backtests and write it down, or you can just save the trades. You can you can download the actual trades, and then you have a spreadsheet that shows all this information if you don't want to have to write it down somewhere. Right. Moving on.
Amanda, I need an executive decision.
No, that's fine. We can continue. My wife and I have a doctor's appointment. I'll just,
No, you can't
no,
be
that's fine.
busy.
We have a little bit more time. I still have to watch the clock a little bit.
All right. Listen, Jason, I'm fine, but I had asked for guidance before we started today, and I was given the guidance of we want to test out a 30-minute session.
That's fair. That's fair.
So that's why I'm asking Amanda to make an executive decision.
Well, we'll do 5 more minutes. I'll help Manny make the executive decision.
All right, there you go.
Thanks, Jason.
All right. I have noticed some days on the Today tab, stock may be flagged for a 14-day pre-earning call, but not the 14-day pre-earning diagonal. Theoretically, at least, would the diagonal have an expected higher probability of profit as the long is 50 deltas versus the short? They wrote 40, but I'm pretty sure they meant 30 delta for a long. Oh, so the long in the diagonal is 50 deltas. The long in the default long call only is 40 deltas. So the question is, would this have an expected higher probability of profit because of the delta selection?
The deltas on the back tests were chosen specifically because on that particular back test with those particular conditions, we found it to have the best result. So we tested a range of deltas for the various strategies. Now, the only reason it's a little harder, I mean, generally, if you're buying a 50 delta, let's just simplify it for like a call spread. If you're buying a 50 delta and then you're selling the 30 delta, you are going to have a higher probability of making some amount of money because your position as a whole costs less. And if the stock doesn't do much or just goes up slightly, you're going to have an expanded window. It's going to cost you less to get into the position, and you're going to have a slightly expanded window on your P&L chart. Now, if you start talking about a diagonal, we found that with those particular, strategies, that it's a little different because the front month is expiring before earnings and the other one is holding the earnings. So it gets a little bit, complicated. I mean, you could definitely backtest side by side, like the, QQQ and see which one has done better over time.
I think you've hit the key. You have to backtest it. And that's why on the Today tab, you might see it under call only, but not under diagonal, because for whatever reason, doing the back test for the same 3, 2, and 1 year, the diagonal did not qualify, whereas the long call only did.
Yeah, especially if you only have like monthlies instead of weeklies. Like some of the strategies need weeklies more than the other ones do. Yeah, and also like with you might have a montage that has very few strikes, and so it's something I will do frequently is if I'm trying to decide if it wants a 40 delta call or something and it doesn't have one, then let's just say that I'm in this expiration, I'm choosing between a 66 and a 24. I'll just test both. And so that's why here there's a 60 and here's a 25 to give you an impression. This isn't a strategy. This is just like a random collection of data. But you can get in here and customize it and say like, okay, I want to look at the 65 delta and I want to look at the 24 delta. And you can see which one has done better over time. So you can kind of get in and for a particular stock, kind of tweak the back test to be closer to, and maybe it's not 30 days from expiration, maybe it's 20 days or 40 days or whatever it is. And so you can say, okay, well, if I enter into it with those conditions, how's it going to do over time?
All right. Very good.
Okay. All right, last question.
Last question. Okay, so I'm going to skip the one I was going to ask. Can you scan for indexes? I thought I saw some ticker ES, some letter in the past webinars. So you can do back tests for SPX, RUT, and NDX. Those are the major indexes that I know, and I've back tested those many times,
QQQ, yeah.
right? I mean,
Yeah. I mean, it depends on what
ETF.
you consider. Yeah. ETF is an index. Yeah.
I'm assuming CCS indexes that he really wanted the,
Oh, just the pure index. Okay, yeah.
yeah.
Obviously, like,
So-
DIA will correlate pretty well to a Dow 30,
yeah. SPY correlates most of the time very well with SPX. XSP, I've never really traded. I know it's a little it's pretty popular in the community.
Yeah.
That's an ETF, right? Can
Yeah, we have
we
a basket of ETFs that we specifically scan against. And so, yeah, that one might not be in the scanner. But yeah, you could also make a request to send a support to say, hey, I can back test on, if it's XPS or XSP. I think I might have actually
yeah,
entered it wrong. But yeah,
XSP.
if we can back test on a particular strategy and you're not seeing it in the scanner, then yeah, certainly you can just let us know.
I'm being told it's the baby SPX.
Okay.
The XSP. I'll look and see if you can back test with it, and I'll send a request into support. Jason, thank you so
XSP.
much.
Likewise.
Thank you
Thanks for being
so
here.
much for taking all this time. Amanda, my apologies for putting you on the spot.
Yeah, it's all good.
And we
Great.
thank you.
No worries,
We thank
Max.
you all for coming.
Yeah, and we'll take well, it's great to see we got a lot of nice questions coming in. Yeah, so next time we might try, this one is going to be intended as more or less a pure Q&A session, but I just had some follow-up from the last that I wanted to get into, and so yeah, next time we'll just carve out a pure Q&A session, and so we can kind of dive into everyone's questions in a little more detail.
All right, and I'm always in community. You can always ask questions in community.
Ask Max in community. All right, thanks everyone. Appreciate you being here.
All right, have a good day, everyone. Stay warm.